All right, short selling. To the average observer, betting against the market feels, well, incredibly complex. But if we strip away the Wall Street jargon, the ticker symbols, and all those dizzying charts, the actual mechanics are surprisingly simple. So let's go back to basics. In this explainer, we're going to unravel exactly how the short works, and we're going to do it using a simple jungle analogy. So, have you ever looked at a completely crashing market and wondered, wait, how are some people still making an absolute fortune right now? Traditional logic always says, buy low, sell high, right? But how can falling prices actually become a highly lucrative opportunity for someone? Section 1. Betting against the banana, the core concept. Okay, we all know bananas have value. But to really grasp the short, we have to completely flip our mindset from wanting the banana to succeed to actually wanting it to fail. Taking a short position means you're making a highly calculated guess that tomorrow people will value this banana way less than they do right now. Your entire strategy for success is anchored completely to the depreciation of this asset. Section 2. The monkey and the friend. The characters. Let's meet our cast. On one side, we have a friend. He's just sitting on a stockpile of bananas, totally unaware of broader market shifts. And on the other side, we have our smart monkey, who's a very proactive trader. Now, the monkey knows the banana is a fluctuating asset, meaning its value goes up and down. But here's the thing. He doesn't actually want bananas. What he wants is the stable currency of the jungle, leaves. He wants to leverage the banana's shifting value to stack up a whole lot more leaves. Section 3. Borrowing and selling. Initiating the trade. To actually bet against this banana, our monkey does something pretty counterintuitive. First, he borrows a banana from his friend. Notice he doesn't buy it, he just borrows it. Then he immediately turns around and sells that borrowed banana to someone else at today's high market price, securing a massive pile of leaves. And finally, he waits. He has just sold something he literally does not own, and now he owes his friend exactly one banana. This exact maneuver, borrowing bananas from a friend just to sell them, is the absolute bedrock of a short sale. You are borrowing an asset to immediately liquidate it. You're borrowing on margin. It's like taking someone else's property with the solemn promise to return it eventually, but your immediate action is to just auction it off to the highest bidder right this second. So right now, the monkey's pockets are absolutely full of leaves, but he's got this looming debt hanging right over his head. Section 4. The price drop, the anticipated crash. So the monkey is waiting. Now, if the price of bananas suddenly skyrockets, he's in huge trouble because he'll have to spend way more leaves than he has just to get one back. But he did his research. The real magic happens when the price of the banana falls. Maybe panic hits, maybe demand dries up, or there's just a massive oversupply. Whatever the reason, suddenly bananas are incredibly cheap. And this right here creates a guaranteed profit margin. Think about the math for a second. The monkey's debt? It hasn't changed at all. He still owes his friend exactly one banana. But look at the staggering difference between that heavy pile of leaves he gained by selling high and the severely dropped cost to buy a new banana today. That gap is pure potential energy. Section 5. The buyback and the profit. Closing the loop. Okay, the time for waiting is officially over. The master plan? Buy them back cheaper later. The monkey takes just a tiny fraction of his leaves, walks into the depressed market, and buys a banana at rock-bottom prices. He has successfully utilized a crash to acquire the exact same asset for a fraction of what he sold it for just days prior. Let's look at the life cycle of this whole trade. On day 1, he borrows and sells high. Then he waits for the crash, which hits around day 5. By day 6, he executes the buyback at the brand new low price. Finally, when he returns that borrowed banana to his friend on day 7, the friend is made totally whole, the debt is settled, and the monkey, well, he's left holding all the extra leaves. Pure profit. You know, the true genius of our smart monkey is pretty multi-layered when you think about it. For starters, he took zero initial risk with his own assets. He used someone else's to play the game. He capitalized on widespread panic to find profit where everyone else only saw losses. He perfectly honored his contract to his friend, and most importantly, by perfectly sequencing these actions, he literally created wealth out of a falling market. So it leaves us with a pretty massive question. If a monkey can execute this with a simple banana and a few leaves, who is doing this right now with our economy? What happens when those bananas are corporate stocks or housing markets or even national currencies? because the mechanics you've just seen play out globally every single day. The next time you see a market plunging, ask yourself, who out there is currently buying back the banana? Thanks for joining us for this explainer. We'll catch you on the next one.